Hi guys, this is Devang Maheshwari from Equialpha.com. 318 employees, business spread across 18 locations like Middle East, Africa, Asia Pacific and Europe. Served more than 30,000 clients till date, and as on March 2020, the company had around 2,800 clients. Yes, I'm talking none other than the Root Mobile IPO. So in this video, we'll discuss about how Root Mobile company is and whether you should subscribe to the company or not. And I will tell you also one important warning that you need to know before subscribing to that IPO, or you can decide not to subscribe after understanding about that warning. So keep watching this full video, hit the bell icon and press the subscribe button. So first, let's understand about the company. The company got incorporated in 2004 by Sandeep Kumar and Rajdeep Kumar Gupta. The company is basically into communication as a service, and as the name suggests, it provides communication services to various enterprises on a cloud-based model. Now, if that is getting too complicated, let me break that up into simple terms. Have you ever received an OTP when you are signing up onto any application or on any website? Have you ever received a message from your banks that this much balance is into your account, or this much balance is remaining into your account, this much money you have transferred to that account? Or you would have definitely booked up some railway ticket or some flight and have got some confirmation message on your mobile. Now all these are services which are provided to these enterprises by Root Mobile. Basically it provides up these communication services like message, voice, email and messages filtering to various different type of organizations, and this is also called as A2P messaging. Now what is A2P messaging? It stands for application to person. Basically the message gets up from the application and reaches to a person. That's how the name A2P got derived. So if you look onto the business is into very growing area, and as you can also see, entire thing is going digital, and the era is just boosted up by this coronavirus. So that had a positive impact on the digital things, and the use of applications will keep on growing. People will use more and more applications. The smartphones are already cheap in cost, so that gives a reasonable assurance that the growth part will be there and will be there for long. Now let us talk about the financials of Root Mobile. The sales have been growing by 38% CAGR since last 2 years, and the PAT has been growing by solid 22% over last 2 years. And the PAT as on March 2020 was 69 crore. So the company has been growing by a decent rate. Not only the top line but the bottom line is also growing by a decent rate. If you talk about the return ratios, the return ratios are very solid. The company has an ROE of 29% and ROCE of 24%, which is very good. And if you look onto other IT companies also, they all have very good ROE, ROCE. The company derives 80% of its revenue from exports. So 80% of the services, the communication services that Root Mobile provide is not in India, but they provide it outside India to various different type of enterprises. And many people pay them upfront. So around 15% of the overall revenue, they receive the fees of these communication services upfront. So it's a good thing, but not that good, because this percentage was around 40% 2 years back. So 2 years back they were receiving upfront revenue, upfront cash of 40%, which is now only 15% left. So that's a decline in that part if you go deep into the revenue side. Now let us understand that what do you need for a long-term holding? Apart from growth, which we already discussed, for a long-term holding in a stock, you need some competitive advantage. Competitive advantage that gives more power to the company when you compare it with the different peers. So competitive advantage are of different kinds, like more pricing power or high entry barriers or low cost producers. So these are just some examples of high competitive advantage. But if you look onto deep into this company, Root Mobile, they don't have such competitive advantage. Basically this communication as a service platform is a very competitive area. It is a very competitive and price sensitive area in which you actually don't have any competitive advantage. And this is also evident from the fact which I just told you about. When you break up and when you see up this revenue, 2 years back it was around 40-45%, which was upfront, which is now only 15%. And that's one fact. The other fact, if you look onto the data days, the data days was 47 days 2 years back, and now it stands at 66 days. So that's around 50% increase in the data days. Now if you see these two facts together, that the upfront revenue declined around 30%. So what was receiving upfront was 45%, which is currently 15%, and the data days at that time was 47 days, which is currently 66 days. Now this is telling you a very good insight. This is telling you an insight that company, in order to gain more clients and in order to keep the existing clients, might have been giving up more credit days which they were not giving earlier. And this is a problem. This is a problem because this is telling you that for growth, for keeping that top line growing, you need to somewhere give more and more credit days, which the company was earlier not giving, but maybe they would have some talk with their client, or for acquiring up new clients, they would have given that extra credit days of 20 days. That's why the data days for overall is now at 66 days. This raises a question that the company has very low pricing power, and for keeping that growth continuing, somewhere the data days might also increase up in future. And this is a low competitive advantage, that for gaining customers or for retaining customers, you just have to give more and more credit days for receiving up to actual money. This is actually representing that the company is somewhere weak in that part, and that is one of the most essential part. So that's the warning which I want to give you all, that though the growth is coming, but the data days are increasing. The sales is growing, but the data days are increasing at a very fast pace. Because of which, what I think is that the quality, which is the return on equity and the return on capital employed, might be on an upper side, and for continuation of the growth, that might go on low in future. Hence the growth that looks qualitative currently, which looks that the growth is now very good at a 29% ROE, this might not be the case in future because of the low competitive advantage. Now let us talk about the valuation part, which is a second thing that you need to look on and think for a second. So we don't have an actual peer which do the exact similar business and already listed, but if you compare to the overall mid sector or mid cap IT sector, you will understand that the range, the 26-27 valuation range is on the upper end, and that's leave a much lesser space, and let's give a less margin of safety for going forward with this company. Now let me tell you about the issue size. The issue size the company is coming around is 600 crores, which is basically a sell off by the promoters, and raising for some additional money for repayment of the debts for their corporate offices, etc., etc. The first day retail subscription that happened yesterday, that was on 9th September, the IPO was fully subscribed. So the participation to the IPO is coming on very good from the retail side. And the IPO frenzy is actually already up. If you look upon the happiest mind, it got subscribed by 150 times by the retail and 350 times by the HNI category. So that gives a lot of craze with regard to retail investors about the IPO, and it can also be because the IPO, there is some IPO which is coming off after months, and that's why it has a lot of expectations built on, and also the stock markets as a general are also going on good till now. So when everything looks good, yes, you will find that the subscriptions are very high, but just looking onto that subscription is not a case. Now what's my final verdict on Route Mobile IPO? So as I told you about the two problems, one is the valuation is not that comfortable, so you have some margin of safety regarding it. And the second thing is the debtors part and the growth part. The fact that the upfront revenue that they were receiving was 45% 2 years back and now at 15%. Simultaneously, you see a data day increase also is telling you that somewhere in the long term, the company might have problem relating to the pricing power. That for pricing power, the data days have to deteriorate more. That can be a case. It's not 100% that might happen, but it's just my observation that I saw after looking deeply into the company. So the retail participation is high and the IPO craze is high. So you might subscribe it for a listing gain, but I'm certainly not subscribing it for a long term, because it's simple. It's simple that the company doesn't have that kind of characteristics which it should have for a long-term holding. And at this valuation, I have already listed companies which are growing up good and have that quality and have that competitive advantage also. So it doesn't make much sense to apply for a long-term holding into this stock, and neither I'll be applying it for the listing gains, if any. If you look onto the grey market premium of Route Mobile, it's at 60% currently, and that's actually good if you want to apply it for a listing gain, but I certainly don't see any quality for a long-term holding. So for long-term holding, this stock doesn't fit into my characteristics which I usually see in buying up any company for a long term. So that's all for video. Stay cautious, not every IPO goes up like big, and just be careful with your money. Thank you for watching. Devang Maheshwari.